What happens to a nation when its money has no one in charge of it? For over 100 years, the United States ran without a central bank. No Federal Reserve. No single institution steering interest rates. No lender of last resort standing behind the system when it broke. And it broke often. Banks failed by the hundreds. Currency changed value depending on which state issued it. Yet somehow, through wars, expansions, and financial panics that would terrify modern markets, the American economy didn't just survive. It grew into the largest on Earth. How is that possible? And why, in the end, did the country decide it needed a central bank after all? The story starts earlier than most people realize. In 1791, Alexander Hamilton pushed through the first Bank of the United States, a federally chartered institution meant to stabilize the young nation's finances and manage its debts. It worked. Prices steadied, credit flowed, but it also terrified people like Thomas Jefferson, who saw a national bank as a dangerous concentration of financial power in a country that had just fought a war against concentrated power. When the bank's charter came up for renewal in 1811, Congress let it die by a single vote. The country limped through the War of 1812 without one, and the chaos that followed, inflation, collapsing state banks, a treasury scrambling to fund the war, convinced Congress to try again. The Second Bank of the United States opened in 1816. It too brought a measure of order, and it too made enemies. Chief among them, Andrew Jackson. Jackson despised the Second Bank. He saw it as a machine built to enrich Eastern elites and foreign investors at the expense of ordinary farmers and workers. In 1832, when the bank's president, Nicholas Biddle, pushed for early recharter, Jackson vetoed it in a message so aggressive it read less like policy and more like a declaration of war. He called the bank a threat to American liberty itself. 2 years later, he pulled federal deposits out entirely. By 1836, the Second Bank of the United States was dead, and with it died America's experiment in central banking for the next 77 years. What came next is what historians call the free banking era, and the name is almost sarcastic in its understatement. States began chartering their own banks with little federal oversight. Each one could issue its own paper currency, backed, in theory, by government bonds or gold held in reserve. In practice, oversight varied wildly. Some banks were solid, others existed mostly on paper, deliberately located in remote, hard-to-reach places specifically so that note holders couldn't easily show up and demand redemption. People called them wildcat banks, and the name stuck because tracking one down felt like hunting an actual wildcat through the woods. By the 1850s, there were literally thousands of different types of banknotes circulating across the country, each with a different value depending on the issuing bank's reputation and distance from where you stood. A merchant in Ohio might discount a New York banknote by 10%. A shopkeeper in Illinois might refuse a Georgia note outright. Counterfeiting thrived in the confusion. Some estimates suggest a third of all currency in circulation by the late 1850s was fake in some form. This was the system America ran on. Not a system, really, more like thousands of small, competing systems, loosely held together by trust and guesswork. Then came the Civil War, and money itself changed shape. To fund the war, the Union government issued paper currency backed by nothing but government promise, the famous greenbacks. For the first time, the country had a truly national paper currency. Congress followed with the National Banking Acts of 1863 and 1864, creating federally chartered banks and a system of national banknotes designed to finally standardize the mess of state currencies. It helped. It didn't fix everything, because here's the deeper flaw nobody had solved. The money supply couldn't flex. Under the national banking system, currency issuance was tied to how many government bonds a bank held, not to how much the economy actually needed to function day to day. Every autumn, when farmers needed cash to move their harvests, demand for currency spiked, and supply simply couldn't stretch to meet it. The system was rigid in a country whose economy was anything but. That rigidity had a cost, and the cost came due again and again. The Panic of 1873 wiped out railroads and triggered a depression that dragged on for years. The Panic of 1893 collapsed hundreds of banks and pushed unemployment past 10%. Each time, the country had no institution designed to step in, calm the markets, and inject liquidity where it was needed. Each time, it had to claw its way back on its own. And then came 1907, the year that quietly rewrote everything. A failed attempt to corner the copper market triggered a run on a major New York trust company. Panic spread fast. Depositors lined up outside banks across the country, desperate to pull their money before their bank became the next to fall. The stock market cratered, and the United States government, with no central bank and no formal mechanism to intervene, essentially did nothing. Because it couldn't. Here's the twist almost nobody expects. The person who stopped the panic of 1907 wasn't a president, a treasury secretary, or any government official at all. It was J.P. Morgan, a private banker, who summoned the heads of New York's major banks into his personal library, locked the doors, and didn't let them leave until they'd all agreed to pool their own money to backstop the failing institutions. One man, in one room, functioning as the central bank the country didn't have. It worked. The panic subsided, but it left Washington staring at an uncomfortable question. What happens next time, if Morgan isn't there, or isn't willing? That question haunted Congress for the next 6 years. In 1910, a small group of senators, bankers, and economists met in near total secrecy at a private club on Jekyll Island, Georgia, traveling under false names to avoid drawing attention to what they were drafting. A blueprint for an American central bank. But what emerged from those closed-door sessions became the foundation of the Federal Reserve Act, signed into law by Woodrow Wilson on December 23, 1913. For the first time since Andrew Jackson killed the second bank nearly 80 years earlier, the United States had a central authority over its money supply, one designed, explicitly, to make sure no private banker would ever again have to personally decide the fate of the American economy from his own living room. So how did the country survive 77 years without one? Not gracefully. Not efficiently. It survived through improvisation, private clearinghouses that acted as informal safety, nets during crises, state-level experiments that occasionally worked and often didn't, and a raw, decentralized resilience that let the economy grow even as it lurched from panic to panic every decade or so. It was a system that punished instability with real human cost. Lost savings, failed farms, entire towns wiped out by a single bank run, but it never fully broke. Until, eventually, it broke often enough that the country decided it couldn't afford to keep gambling on improvisation. What's worth sitting with is this. The Federal Reserve wasn't born from careful long-term planning. It was born from panic, from a single private citizen having the power to decide whether the American economy lived or died, and a government that realized it could never let that happen again. Every financial system carries that same tension inside it, even now. The trade-off between control and freedom, between stability and the risk of concentrating too much power in too few hands. America spent over a century learning that lesson the hard way. The question worth asking is whether it ever really finished learning it at all.